Good morning, guys. This is ACBP622 session for Masterclass. There were no students available at the beginning of the session, but I do see that there are a couple of students online. Just you're more than welcome to ask any questions or queries you have regarding the module. But what I'm just gonna do now is just continue with the session, basically doing the 2024 exam. Um, for recording purposes so that the other students can find this on the YouTube. But if you have any questions before that, you're more than welcome to ask any questions. That's what I'll be doing just now. With me, I have a 2024 exam. This is question number one. Question number one is speaking about I think it's the IS10 events after the reporting period. So your exam is also expected to be the same, similar basically. It's going to cover all of the learning units for the second semester, but obviously the majority would be the learning units after test two. So all of those learning units will be covered extensively, and then the other learning units would have been covered in test one or test two. So this question number one here is about IS10. So it says here, there are two independent parts of part A. YOLO Limited declared two dividends on the following dates. So we have number one, a dividend of 650 on 30 June 2023. And then number B, a dividend of 360 again on 15 August 2023. So the year end is 30 June. 30 June. So in this case, the year would have ended on 30 June 2023. That means that the first dividends that was declared on the 30 June 2023, it's going to be an adjusting event based on the fact that it was declared before the year ended. So basically, the declaration of it would have given it the obligating event, which is a constructive obligating event. And then for B, the dividend was declared after year end, so then it would be an unadjusting event because the declaration happened after year end, meaning that there was no obligating event as at year end. The obligating event only arose on the 15th of August on the date of declaration. So that means that it would need to be disclosed on the financial statements as on 30 June 2023. However, it would be an unadjusting event. So that one is very fair and simple. There's no reason for us to go and dive into that, but let me just check what the requirements wanted of us. So discuss whether the events are adjusting. Okay, so the first one, it's adjusting. Then B, it's non-adjusting. Where the events are adjusting, provide appropriate journals. Okay, so for the first one, where it's an adjusting, the journal entries would be debit dividends expense for 650, and then credit dividends payable, which is a liability, 650. So that's the transaction that you would have to record in that one. And then let's check at part B. What's happening in part B? Part B, Flintstone Limited entered into a contract with the customer on the 1st of January 2022 to sell an item of machinery that Flintstone Limited had constructed. Okay, so Flintstone has constructed a machinery, so they are selling it. So I guess it's part of their inventory. Control of the machine, however, will only vest in 2 years' time. That means that we will only send a control to a customer in 2 years' time and not currently. So if we are to think about this in terms of IFRS 15 revenue, it would mean that we would only be entitled to recognize the revenue as soon as we had delivered the service. So if we haven't delivered the service, or basically if we haven't transferred control to the customer, then we have no business recognizing revenue. We only have business recognizing revenue when we have fulfilled our performance obligation, basically step number 5. So he says that in terms of the contract, the customer must pay 325 immediately. Okay. The appropriate discount rate used by the company was 8%. Okay. The year end is 30 June. Okay, so let me just open up an Excel sheet. Okay, I think let me just project. Let me just stop. Project my entire screen. Entire screen. Okay, perfect. Project my entire screen. So where is this? Okay, perfect. So to answer so the revenue part. So when we're selling the machinery, remember the idea or the biggest crux is to follow all the 5-step approach, which is your um basically the one step that we need to follow is the last one in this case here, which is we only recognize revenue when we have fulfilled our performance obligation. So that's what we need to consider in here. Right. So they say here, and they mention that on the 1st of January 2022, we received 325, but we are only selling this machinery, or we are only giving control of this machinery on a certain date. So let's do that. So on the 1st of January 2022, yes. So that's the transaction date. So what would have happened in this case? So we received an amount. So debit bank, because we received an amount from the customer as fee. The amount is 325. Okay. Let me just say, just trying to 325. So it's going to be 325 and 23. Okay. And then we're crediting contract liability. Remember, we can't credit revenue at this point in time because we haven't fulfilled step number 5. Step number 5 states that we only recognize revenue when we have performed or we fulfilled our performance obligation. In this time, we haven't yet transferred the actual control from us, which is the entity, to the customer. So hence now we're recognizing contract liability. So what does it mean? It just simply means that we owe this person the actual machinery, or we still owe a certain performance obligation. So in this case, our narration would be, and I know they didn't request for a narration, but it's always nice to provide a narration in this case. So recognizing the receipt of cash for machinery. Okay. And then it's contract liability, of course. And then now let's go to the year end, which is 30 June 2022. 30 June, we will need to obviously account for the term value of money in this now on 30 June. Hence, they gave us the percentages, the percentage for the discounting rate. Let's just go back and confirm. They gave us the appropriate discount rate would be 8%. So hence we will use this 8% to account for the time value of money for this question in here. So on 30 June now, which is the year end, we will need to account for that time value of money based on that 325 that we have already recognized. So in this case, we're going to say here 30 June 2022. Okay. So then how do we then record the transaction? It's very simple. So we're going to debit interest expense, debit. Okay, let me just put it down here. Debit interest expense, or we can call it finance cost, whichever the case is fine. It's going to end on the statement of profit and loss. How do we calculate it? It's very simple. 325,000 multiplied by 8%. And then we should get how much in there? We should get 13,000, I think. I hope it is. 13,123. Or also take into account the fact that we did this on the 1st of January 2022. So that means the interest will not be for the full year, but will be for the 6 months. Because 1st of January up until 30 June, that's 6 months. So multiply by 6 over 12. It's perfect. Right. And then what else are we going to? So it's going to be the contract liability credit, contract liability, SFP. 1813. So what's the reason? It's basically providing for the interest, time value of money, Okay, perfect. Okay. And then we'll need to go to the next day of assessment, which is 30 June 2023. So 30 June 2023. So we're going to do the same thing, similar transaction basically. this one, obviously with different calculations this time. So now, because now it's a full year, we don't need to account for the 6/12. We just simply need to account for the full 8%. So let me just erase the 6/12 from there. Yeah. Okay, so it's going to be 3 to 5. How much is that? It's going to be 27, 14, 27 or 14. Okay. And then 1 January 2024, 1 January 2024. Debit. We're gonna do the same now, but just for 6 months now. Since after June, it would have been 6 months till January. So we'll do the same thing. So do the same thing. But now accounting for 6 months. In this case, accounting for 6 months. So it's going to be, sorry, plus, come on, okay, plus 13K. Where is this 13K coming from? It's that one. Because remember, the interest is capitalized on the contract liability. So we had 325 initially, which is this one, 325. Then we calculated the interest, basically increasing our contract liability. So our contract liability is not only 325, but rather 325 plus 13K on 30 June. And then on 30 June 2023, it's going to be 325 plus 13K plus 27. Right, hopefully that makes sense. So here it's going to be 325K plus 13K plus 27K, which is the one above, the 27 or 40. So hopefully that makes sense. And then multiply by 8% and then multiply by 6/12. For the fact that we are on the 1st of January, and from 30th June 2023 up until the 1st of January, that's 6 months. So hence we are accounting for that one. So it's going to be 14,602. I hope so. 14,602. Perfect. And then now the last transaction, now we're able to recognize revenue. So that means we're going to debit contract liability because now we no longer have a liability. And then we're going to credit revenue because now control is left. Basically control has been transferred from us to the client. P&L, how much is that? It's going to be now 379. So if you add all of that above, they should get 379,642. 379,642. 379,642. Okay. And then let's go to question number 2. Question. So this was 15 marks. Question 2. So question 2 is also an independent part. It says here, part A, we have Coco Limited, who offers its employees post-employment benefit in the form of defined benefit plan. The entity has a 30 June year end, and below are the details of the current year. So we have plans asset and then plan obligation. So we will need 2 columns basically for the planned asset and then the plan obligation. And then obviously when we're providing a note, if we are going to be asked for a note, we will need those 2 columns. So basically your opening balance and your interest and all of that stuff. And then it says your interest applicable to the plan is 10.5%. Benefits of 1.3 million are paid to the current year. So we need to take that into account. Contributions to the plan were 5.3. We'll need to take that into account. Okay. Current service costs amounted to 4.1 in the 2024 year end. prepare the reconciliation of the opening to closing balance of the net plan on 30 June 2024. So we're required on 30 June 2024. So we're supposed to provide a reconciliation for that one. So this is very simple. All we just need to do in this case, we just need to provide the table, basically a reconciliation of the opening and then the closing balance. Okay, so we need two columns. Remember, for the plan asset, and then from the plan obligation. Okay, and then we're going to need the net now. The third column, which is now providing the net. So it's plan, not plant. Sorry for that. Plan asset, plan obligation, plan asset, plan obligation. It's net. So here we have an opening balance, opening balance. Okay, opening balance. And then we will have what is usually, I think it's in, let's just say benefits paid first. Benefits paid, and then we have interest, and then we have contributions. I think contributions. Contributions, because they mentioned some contributions in there. Then current service cost. Okay, then we have a closing balance. Okay, that should do. If we need anything, we'll just add it on here. Okay, so let's check the opening balance. Let's check the information that we have. Okay, so we have 4.8, which is for the opening balance for the planned asset, and then 5,250 for the plan obligation. So we'll put those in down. Okay, so for the planned asset, it's going to be 4.8, 1 to 3. Perfect. And then for the other one, it's going to be 5,250, 1 to 3. Perfect. And when you add all this together, you should get, because now it's an asset and it's an obligation. So that means that if it's an asset, it's a positive figure. Basically, think of it as a positive figure. Then obligation is a liability. So in this case, it means our obligations are more than our assets. So that means we'll have a negative net. I hope that makes sense. So it's going to be that one minus this. Actually, so it's going to be, let's do the normal way. So it's going to be this minus that. Yeah. Perfect. Yeah, that makes sense. So we're going to have a negative 450. And then now we have interest. Interest is basically 10.5%. So it's going to be 4.8 for an asset. It's going to be 4.8 multiplied by, sorry, benefits paid. Don't worry, we're going to come back to benefits paid interest. So it's going to be 4.8 multiplied by 10.25%. Where is this 10.25%? It's given. There it is, 10.5%. It's given to us. So we 4.8 multiplied by that. That's going to be 504,123. And then 5,250,000 multiplied by 10.5. That's going to be 551,250. 1,250. So in this case, we do the same thing that we did in here. 1 minus that guy over there. Perfect. All right. And then benefits paid, I think we were given as well. Let's just confirm. Given 1.3. Yes, benefits paid 1.3. Perfect. Let's go to benefits paid 1.3. So 1, 3, 1 to 3. 1, 3, 1 to 3. It's gonna be 0. Okay. And then contributions, we were told the contributions as well. So it shouldn't have, if we were told it's 5.3. Okay. Contributions of 5, 1 to 3, 1 to 3. Okay. And then that gives us equals to this minus that. Perfect. Right. And then we current service costs. Current service costs, we were also given those ones. We were given how much they were, 4.1 into 3. That's the current service costs. So equals to minus this one. Perfect. And then we have a closing balance. So closing balance is simply just going to be a culmination of all of these amounts in here. So it's going to be 9,304. 1, 2, 3. So if you just add all of that together, then it's going to be 8601 250. Then, yep, that's perfect then. Then we just put that all off on the thingy, on the columns. And you put those big things in there. Yeah, that should be fine. Right, all right, all right, all right, all right, all right. Then you go to number B. B, it says here, on the 1st of April 2023, TJ Limited took out an interest-free loan at a foreign bank for 200,000 to finance the purchase of a building. So this is IS 21. Then it says on 30 September, so they took this on the 1st of April 2023. Then on the 30th of September 2023, TJ paid the foreign loan in full. The following exchange rates are applicable for the 2023 financial year end. So on the 1st of April, we have 18.50 exchange rate, 18.20 in 30 September, 31st of December, that's 18.17. So I think we are going to be providing journal entries in there. Let's just confirm. Required to prepare the journals entries to be processed for the loan. Okay, this one should be simple. Okay, so let's do that. Let's just use this same thing. Okay. So we're going to speak about 1st of April. 1st of April 2023. Debit bank, because we received some money since we took out a foreign loan. So we received that money. So it was, the exchange rate was 18.50, right? Yeah, I think so. Let's just confirm. Yes, 18.50 on the thingy. Okay. So we're going to say then 200K, 1, 2, 3, multiply by 18 rands 50, 18 rands 50, 18 rands 50, 18 rands 50, that's 3,723. That's 3,723. Okay, so credit, it's a loan, liability, it's SFP. Okay, perfect. And then obviously this is the recognition of a loan, recognition of the loan. And then on 30th September 2023. So that's the year end, I think so. Yeah, the year end. So we are going to debit loan payable, or loan liability, because now we're paying it, right? SFP, so that means we no longer have this liability with us, and we are relinquishing all of it. So we're paying it 3.7, and then we're crediting bank, because now money is going out of our bank account. So hence we're crediting that bank. So the bank in this case being now 200K times 18 rands, 20, 18 rands, 20. And then now we have 3,640, because now we're paying at a lesser amount. That means now if we're paying the lesser amount, we've made a gain. Forex gain. It's going to go through P&L. P&L. The difference would be that one. It's basically 60K. 60K. Perfect. And then what are we doing? We are simply just we are settlement of a loan, basically. Settlement of the loan. Okay. And then let's check now the next question that we have. Okay, question 3. So question 3 is very much easier. because it deals with earnings per share, something that we've majorly and extensively covered for test two. Is it test two? Yeah, but basically in the previous tests. So part A, Duffy Limited at 2.5 million 3 rands ordinary shares in issue on the 1st of July 2023. On the 1st of October 2023, Duffy Limited had a share consolidation on a 1-for-4 basis. There was no outflow of resources arising from the consolidation. The 1st of June 2024, Duffy Limited issued 125 shares at 4 rands as issue for value. So share consolidation is issue for no value. Then the other one is issue for value. Okay. Then they say here, calculate the basic earnings per share. No comparatives are required. Right, all right. This one, I am not gonna answer that one. I'm hoping the students will answer it, and then I can just simply provide a solution to them. I'm hoping that they will be interested to answer that one. It's very much simpler. It's earnings per share. It's no complication at all. And then we go to B, and also B, it's borrowing costs. So borrowing costs, I also expect students to know this one: calculation of the capitalization rate, calculation of the amount of the borrowing cost eligible for capitalization. So all of this stuff is something that we're very much familiar with. So I'm just going to spend time on the things that we don't know yet, or the things that we don't have much. Yes, like question 4. Perfect. Question 4. So we're going to do this one together. Right, let's just go back to the scenario. Okay, question 4. We have Scooby Limited who owns a building that it lists to Rogers Limited. Okay, so Scooby Limited owns a building, so they own a building, but it lists to Roger Limited. So if we go back to the first semester, when you're dealing with something like that, you would know that it's specifically speaking about investment property. So if you own a building and then for some reason you are listing it to out somebody else, that's an investment property. So it says here, the cost of the building at the date of the acquisition on the 1st of January was 4.5 million. So when we bought this, it was 4.5 million. The estimated useful life of the building from the date of acquisition is 20 years. At acquisition, the property was accounted for on the cost model in terms of IS 40 investment property. But at the 1st December 2023, management decided to account for all of its assets held under IS 40 in terms of the fair value, as it would faithfully represent the position of the company. So again, this is clearly a change in accounting policy, so we need to account for that one using IAS 8. So the valuer determined the following fair values of the property as follows. So on the 1st of December 2021, it's 6.750, 2022, it's 5.625, 2023, it's 8.325. So they say here for question 4.1, we must calculate the carrying amount of the investment profit before it changes, before the changes in accounting policy. That is very simple. So we're just going to do that one just now. So they say we must calculate the carrying amount of this investment profit before the changes in accounting policy. So we had a cost of it 4.513. Then obviously divided by 20 years, because we were told the useful life is 20 years, then multiply by 3 years. Okay. Multiply by 3 years, and then we should get then how much. It's 675, I think. 675 1 2 3 675 1 2 3. Okay, perfect. And then when we've gotten that one figure in there, then the carrying amount will be 4.5 million, 4.5 M minus the 675K, which gives us now 3,825,123. 3,825,123. Perfect. Then let's go to number B. What does number B want out of us? Number B says that now, after we've calculated that, let's prepare only the change in accounting policy note for Scooby Limited for the year ended. That's for 12 marks. It's very simple. So all we need to do is to obviously provide our what do you call presentation? So it's notes to the financial statements. Also the financial statements. So it's going to be an extract because we're not providing all the notes. For the year ended, for the year ended, for the year ended, that's 31st December, so 31st December 2023. Perfect. And then we need to provide now, let's just call it number 4, not number 4, yeah? It's going to be changes in accounting policy. Changes in accounting policy, that's the note we are required to do. Okay, so the very first thing we need to do is to provide them the description of what happened. So basically just explaining why are we talking about a changes in accounting policy, what is the root cause for this note. So we can just mention that IP, investment property, was changed in the current year from the cost model to revaluation model. Okay. To provide um, a more fair presentation, Yeah, all of that. Make sure you provide all of that stuff in there. Otherwise, I'm not overly concerned with that one. And then effects on change in accounting policy. Okay, so we'll have effects on the statement of profit and loss. Okay, so how will this affect? Then we will have increase or decrease. Don't forget that power move in there. It's important. Increase or decrease. Increase or decrease in fair value adjustment. Fair value adjustment. So we'll need to have 2023, the current year of assessment, 2022. Okay, perfect. And then this is okay, let's check now 2023. Let's go back to the information just to confirm 2023. So we have in 2023 we have 8,325 minus 5,625. So that should give us, if we say that minus that should give us no 2.7. Yeah, 2.7. 2.7. So we have 2,700, 1 to 3. Perfect. And then that's an increase in fair value adjustment. That would have increased the fair value adjustment. And then in 2022, let's just confirm 2022, the movement we have would be, so it decreased. So the first one was 6,750,000, decreased to 5. Okay, so it's going to be in decrease. Okay, sure. So 6,750,000 minus that one, that should be 1,112,4. Yeah, okay, sure. So it's gonna be 1,001,25,123. Yeah, perfect. All right. And then we talk about depreciation now, okay? Because now remember, due to the change, the depreciation is going to be affected as well. So we're going to have a decline in depreciation of 225. Depreciation of 225. So decrease and depreciation, 225, 123, 225, 123. Perfect. And then obviously this will result in increases or decreases in profits. Increase or decrease in profit before tax. Okay. Decreases in profit before tax. Okay. So it's simple. 2.7 plus 225. That's going to be 2,925, 123. And then that one is going to be minus 923. Lovely. And then now we're going to have effects on RE, retained earnings. Basically, effects on the statement of changes in equity and statement of financial position. Financial position, that's right. Financial position. Okay. Statement of changes. Okay, so we've decrease in depreciation. Decrease in depreciation. We've already mentioned that one above. Depreciation, so it's going to be 625. Oh, sorry, 225. 225. The one above 225. And then increase in fair value adjustments. Okay. Then increase in fair value adjustment. Here's 6,750. 1, 2, 3. Minus 4. Then you get that one, which is 250. 1, 2, 3. And the increase in RE, therefore increase in RE, retained earnings. That means then it's going to be 2,475. 1, 2, 3. Right. Yep. Then that's the perfect. That's the solution for that one. Then let's go back to the question paper. Okay. And then question number 5. Question number 5 now. It's saying you have been presented with the statement of financial position and the statement of profits and loss and other comprehensive income for Daisy Limited for the year ended 29 February 2024. I think this is going to be a cash flow. Okay. And it's for 40 marks. Okay. So they say here we have revenue, cost of sales. It looks like we've given almost everything in here. Valuation surplus, profit before tax, assets, PPE, a bank. Okay, we will need this one as well. Bank 850. And then we will need $275. Short-term investments. Oh, one thing we'll also need as well is this one. So the opening balance for bank would be this and the 35,600. Not only the 850. Then what else? And then the closing, sorry, the opening balance will be 275. Okay, that makes sense. Okay. So without wasting any time, let's do. So we're going to need, says the cash flow statement for Daisy Limited. So we have Daisy Limited statement. So let me just increase this thing in. Statement of cash flows. Okay. Statement of cash flows. So I think we're going to, let's just confirm which method that did they ask us, or are they going to ask us for which method? Short-term investment are highly liquid. Okay, so that means they are properly complete using the indirect method. Okay, perfect. The indirect method. Right, so we have for the year ended, that's going to be 29 February 2024. Okay, and then we are going to have cash flows from operating activities, right? Yeah, operating activities. Okay, I know we're going to have a lot of things to include in there, but for the purposes of doing this, okay, so let's put it down and put this one. So after operating, we'll have investing activities. Okay, let's put that one in there. Investing Okay, then after investing activities, we'll have cash flows from financing activities. So let's grab that down, put it there. So we're going to have now financing activities, financing activities. And then once we're done with this, we're going to have the last entries now that we will need, which is so I just need the last part, the reconciliation of cash and cash equivalents. Okay, so opening balance, cash and cash equivalents, opening balance. So we were given that one. So let's go and confirm. Where are we taking this amount? We're taking it from the bank. So 275. So we're going to have 275. So basically it's 275 plus 0. So the short-term investments in the banks should be in one account. So 275 plus 0, it's going to be, so there's going to be opening balance. Opening balance. So it's going to be 275 into 3. Okay. And then we'll do the same, but now for a closing balance. So it's going to be closing balance. Closing balance. Okay, closing balance is going to be, let's go and confirm. It's 850 plus 35, 600. 850 plus 35, 600. That's going to be 885, 600. Okay. And then net movement. Net movement. Net movement. Net movement. Net movement. Net movement, it's going to be obviously that minus that one. Then we're going to have 610, 600. That's basically what our net movement should be. When we're done calculating all of this stuff, we should have that 610, 600 in there. Right. So let's quickly then fill up our cash flow. Cash flow statement. So we will need obviously more lines in here. Let me just add more. Okay, so if we're using the indirect method, so that means we'll start with profit before tax. Profit before tax, what's the value for that profit before tax? Profit before tax, show yourself, where are you? There it is, profit before tax. That's going to be 1230, 1230, 1230, 123. Okay, perfect. And then adjust for depreciation. I know there will be depreciation. We just need to find out which one it is that we have. So let's go and check on our information that we're given in them. Shares were issued. Depreciation for the year and the sale amounted to is including admin cost. Property, plant and equipment is 80,000. And the carrying value is, okay, so let's check. Okay, the end carrying values of the PPE were as follows. Accumulated depreciation, okay, 350. Okay, so you can use that 350. And then what other one that we're looking for? Then it says a property, plant and equipment with a cost of 80,000. The cost of 80,000 and a carrying value of, okay, so we'll use the 40,000. Okay, so we're going to say 300, so 350 minus 300 to find the depreciation. Okay, and then plus 40,000, which is the one that 40,000, and then we should be able to find our depreciation. Okay, perfect. So let's do that. So we're going to have 350. That's the closing balance of the accumulated depreciation, then minus 300, and then plus 4K, and then we should be able to get, is it 90K? 123. Yes, perfect. Okay. Okay, and then we have, let's check what else do we have in there. Do we have a loss or a profit? It says here Depreciation for the year and profit and loss on sale. Okay, so that means we did sell something. So we had was sold for the year. Okay, so was sold for 30, but it had okay, that means we made a loss. Okay. So loss on sale of assets, because we had a carrying amount of 40,000, but we sold it for 30K. That means we've made a loss of 10,000. Okay. Let's check what else is needed in here. The year end, the revaluation. I want to see what else has been sold. The year end carrying amount. Other income comprises of interest received from the year end, profit on sale of the profit on sale. It's given. There's no need to calculate profit on sale of the non-current asset. Okay. Profit on sale, profit on sale, profit on sale, profit on sale of non-current assets. It's given. So minus 51 to 3. Okay. And then interest expense. That one is very simple. Where is it? Show yourself, show yourself. Interest expense, show yourself. Yes, there it is. Interest expense, finance cost. Okay, perfect. So interest expense, just for interest expense, interest expense being 50,000. Okay. And then, okay, I just need to add more lines in here. Interest expense. Right. And then interest income as well. Interest income. Interest income as well. Let's check it out. Interest income. Let's check it out. What's happening in interest income? They did tell us information. I'm pretty sure about it. Interest received. Yes. Okay. So 75 minus 50. Okay. 75 minus 50. Then we should get the interest income one because the total was okay. 75 minus 50. Okay, perfect. So 75K minus 50K just to get the interest income, because what's included in there is both the 50K plus the interest income. So we just need to find the portion of the interest income. So that gives us 25,000, 25,000. Remember, the 50K is the one above. It's the one from the profit on sale of non-current, because they said this 50K is included in that thingy in the interest income. And we know that was the total was 75K. It includes 50,000. So we just need to find out the value of the interest income, which is 25K. Right. And then we go to changes in working capital. Changes in working capital. Okay, so we're going to find so it's going to be a decrease, ne? Decrease, an increase or a decrease in inventory. Okay, let's just say movement, because it's going to confuse me now. Movement in inventory. Okay, so let's go and check what happened in inventory. Okay, inventory, show yourself. There it is. Inventory from last year was 750. It increased to this year to 900. Okay, so there was an increase. So 900K minus 750. Okay, that's gonna give us 150, right? Yeah. Right, and then we do the same thing. Movement in trade receivables. So let's go and check what's happening in trade receivables. Movement in trade receivables would be from 400 to 3. So from 350 to 400, it also increased. So 400K minus 350K. Okay, perfect. And then we will have and that gives us 50.13. So it's going to be minus 50.3. And then last but not least, we go to movement in payables. Okay. Movement in payables. Let's go movement in payables. Movement in payables. Show yourself payables. Movement in payables. Movement in payables. It increased from 150 to 225, right? Yeah, 150 to 225. Okay. 225K minus 150K minus 150K. Okay, and then that means we have 75,000, right? 10, 2, 3. Right, and then now that will give us the cash generated from operations. You just need to add a few lines in there. Cash generated from operations. Cash generated from operations. That would make it, if you add all of that, one should give you that. Yeah, 1230 plus 90 plus 10, that's 100K, minus 50 minus plus 50 plus, yeah, okay, perfect. No, that's fine. I think that's fine. Right, and then we have interest paid. Interest paid, minus 50. Okay, and then we have dividends paid. Dividends paid, let's go and check. Surely they gave us something in there about dividends paid. Ooh, dividends paid. What is it that they told us here? Dividends 125. Yes. Okay. So it's given. Okay, the one that we need to calculate, I think it's tax paid. Okay. We always need to calculate this one. I'm sure of it. I'm very much sure of it. So let's just check. What do they tell us on tax side? Tax. We know that we have current tax level. Okay, so we will use this 200K here, and then we will use the 175 as well. So basically, it's going to be the opening balance plus, which is 175 plus the tax for the current year. What is the tax? Is 344. Perfect. So it's going to be the opening balance plus 344, therefore minus the closing balance, and then that's the amount we have for tax paid. Very nice and simple. So let's do that. So it's going to be the opening balance, which is the 175K plus the current year's tax, which is on the income statement. So it's 344,400, is it? I think so, yeah. And then minus 200K, which is the closing balance. Therefore, we shall get 319,400. Perfect. And then now we have net cash flows from operating activities. I think, I hope it balances at the end of the day. Ooh, cash flows, net cash flows from operating activities. So that's going to give us, so that was 1,180 minus 50K minus 105 minus 219. That's 685. 600. Perfect. Okay. Right. So now we go to investing activities. Investing activities. What do we have for investing activities? We will have acquisition of, or the purchase of PPE. Let's just confirm if, because it does look like there was a purchase of PPE, right? Yeah, it definitely increased. So there must have been a movement in there. Let's just check. Yeah, that definitely does suggest that there was a purchase of PPE that really occurred in here. So we have the carrying value of just 950, and then we had 40,000, which was the carrying amount. And then 90,000, which was the 90,000. Was it the one that is sold? Okay. And then what else is there? Then 450 being the closing balance. And then 110. Okay. Okay, okay, let's do that then. Because we have that purchase of PPE, purchase of PPE. Okay, this purchase of PPE would be, okay. So make sure you go through the question as well, just to check and confirm the numbers. 950 was the thingy, the balance on that account. Was the balance on that account? 40K. And 40K was the one sold. Then the depreciation as well. Okay. 90K. And then the closing balance of 450K, that account. 110K from the above movement. 950 plus minus. That gives us minus 520, because remember, you're purchasing, it's okay, perfect. Right, so let's check what other asset do they have in there, if there's any movement. So intangible assets, there's an increase there. Intangible assets, surely there's something that happened. Okay, intangible assets, yeah, we surely did purchase an intangible asset. Purchase of intangible asset, that's gonna be 500K minus 450K. That's going to be minus 50, 1, 2, 3. Right, disposal of PPE. If we've sold something, we're given this amount. Disposal of PPE for 30K. That's the amount we received, basically, remember, from the above, yeah. Disposal of non-current investment, because I think we sold then. Disposal of non-current investment. Let's confirm actually if we did, or we just now just listing items unnecessarily. Disposal, yeah. See, we had 150 at the beginning, now it's 0. Surely we did sell it. Okay. Okay, thank God. So that means we will have 150 plus 50, in this case 150K plus 50K, because we sold it at an extra amount of 50,000. We've made a profit basically for the sake that amount. So it's 200K. Is it? Yeah, 200K. And then we received interest income of 25,000. 75 minus 50. Yes, interest income. Probably wondering, why do we have it here? The slides, and hopefully your lecturers were able to tell you why you would have interest under investing. This should be investing activities, right? Why am I in financing activities? It's fine. I will fix that word. It's investing, and then I will just, let me just delete this one here. Okay, perfect. Right. And then net cash flows from more items in here. Okay. Net cash flows from investing activities. Okay, net cash flows from investing activities. So we have 520, 50, 30, 200, 25. That's going to give us negative. Take the sign for bigger one. It's going to be negative 315, 123. I think, I hope so. Right. And then now we go to financing activities. So that was investing activities. No. So we just want to go through financing activities. Okay. Just put it here. Financing activities. Financing activities. So under financing activities, issue of share capital, right? Like, because I'm sure we've made issue of share capital. So let's go and confirm before we jump the gun. Share capital. There is 350 increased to 490. Let's just check if there was more additional information. Shares were issued paid. We have in there 490 490k minus 350k. And then there's gonna be a cash injection of 140,000. Sure. 140,000. 140,000. Okay. And then acquisition of a long term. Let's just check loans. Did we make any or did we pay back any loans? It looked like we made more loans because last year we had 200k, now we have 300, so we've made more loans. So loans raised. Okay. Loans that were raised in the current year would be 300k then minus the 200k, which then gives us the 100, 1, 2, 3. Right. Then we have net cash flows from financing services, financing activities. So if you add all of those together, they should give us 240, right? Okay, perfect. And then now let's do this. Let's just confirm. So if we say 685,600 minus 315 plus 240. Yes, it does give us the 610. Lovely. Okay, that means we wasted our casual bus. It answers. Lovely stuff, lovely stuff. Okay. Then the rest of the question here, I'm going to leave that to you guys. So obviously you will get the solution from me should you submit all of your workings. The rest of the stuff is easy, especially this one, the government thingy, the government grants, the IS-20, similar to borrowing costs, easier standards. Those are easy standards. Then question number 7, what is it talking about? Oh, it's theory now. They are asking us here, what of the Companies Act, what should we consider in terms of issuing this dividend? I love this question. It's very nice and simple. So remember, guys, whenever we issue or declare a dividend in terms of the Companies Act, we must always perform a Section 4 test. What is a Section 4 test? It's the solvency and the liquidity. What is solvency? You're looking at all of your liabilities, total liabilities versus total current, versus total assets. And then if you have a positive solvency, which is basically your assets are more than your liabilities, that means that's a green light in terms of your declaration. That means you can declare the thingy, the dividend. And also that's your solvency now. And then you're looking at the liquidity. Liquidity now would be your current. So basically the reason why they gave you the balance sheet in here is for you to be able to calculate those. And also you must do those tests immediately after taking into account the proposed distribution. So make sure you calculate those 2 tests those are the tests that they are asking you about. You just take all of your liabilities minus your assets. That's for solvency. Then for liquidity, you look at the current ones. So take your current assets minus your current liabilities, and then minus the dividend. And then if you get a positive answer, that means it's a green light for you to issue a dividend. Otherwise, if you are having problems with solvency and liquidity, therefore you have no business declaring dividends. So you should always have a positive solvency test or liquidity test. That's the idea behind. So yes, that's it for me on my side. Should you guys, let me just go back to the screen. Hopefully there are still people in the session. Please, if you need the solution to this, you're more than welcome to send me an email. Let me drop my email in here on the chat so that you can forward me any queries you have regarding this. So Z at iie.ac.za. Yeah, I think that is it. Let me just confirm if that's me. But yes, should you guys require anything out of me, that's my email. Yeah, other than that, thank you. Thank you for attending. That's it on my side.